studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
Corporate tax installments allow corporations to pay their estimated income taxes gradually throughout the year instead of making one large payment after the fiscal year ends. Since corporations usually earn income month after month, the Canada Revenue Agency requires many corporations to pay their taxes in installments as those profits are being earned. This approach helps spread the tax burden over the year and reduces the amount that remains payable when the annual T2 corporate tax return is filed. Imagine a corporation that generates revenue every month, rather than waiting until the end of the year and paying a large lump sum of corporate income tax. The corporation estimates how much tax it is likely to owe for the entire year. Based on that estimate, it makes regular installment payments to the CRA throughout the year. These payments are essentially advance payments of the corporation's expected annual tax liability. The process is straightforward. First, the corporation earns profits from its business operations. Next, it estimates its total corporate income tax for the year. It then pays installments typically every month, or in some cases every quarter based on CRA rules. After the fiscal year ends, the corporation prepares and files its T2 corporate tax return. At that point, the actual tax liability is calculated and compared with the installments already paid. If the installments were less than the final tax owing, the corporation pays the remaining balance. If the installments exceeded the final tax liability, the corporation may receive a refund or have the excess applied to future tax obligations. One of the biggest advantages of installment payments is improved cash flow management. Instead of facing one very large tax bill at year-end, the corporation makes smaller, more manageable payments throughout the year. This not only makes financial planning easier, but also reduces the risk of cash flow problems when taxes become due. Corporate tax installments also help corporations remain compliant with CRA requirements. By paying taxes throughout the year, businesses reduce the likelihood of large interest charges that could arise from waiting until the end of the year to pay the entire tax balance. As a result, year-end tax settlements are often much smaller and easier to manage. The key takeaway is that corporate tax installments are advance payments of a corporation's estimated annual income tax. They allow corporations to spread tax payments over the course of the year, improve cash flow, and reduce the amount payable when the T2 corporate tax return is ultimately filed. This makes the corporate tax system more predictable for both businesses and the CRA. Not every corporation is required to make corporate tax installment payments. The Canada Revenue Agency has specific rules that determine whether installments are required, how often they must be paid, and whether a corporation qualifies for monthly or quarterly payments. Understanding these rules is an important part of corporate tax planning and helps businesses avoid unnecessary interest and penalties. The first question to ask is whether the corporation's estimated tax owing exceeds the CRA's installment threshold. If the corporation's tax liability is below the required threshold, installment payments are generally not required, and the corporation can simply pay any balance owing by the regular balance due date after the fiscal year ends. However, if the estimated tax exceeds the threshold, the corporation will generally be required to make installment payments throughout the year. The next step is determining whether the corporation qualifies as an eligible Canadian-controlled private corporation, or CCPC. This distinction is important because certain qualifying CCPCs may be allowed to make quarterly installment payments instead of monthly payments. Quarterly installments reduce the number of required payments from 12 each year to just 4, making cash flow management simpler for many smaller businesses. If the corporation does not qualify for quarterly installments, it will generally be required to make monthly installment payments. These payments are spread evenly throughout the year and help ensure that the corporation pays its estimated income tax gradually as profits are earned. Large corporations and corporations that do not meet the CRA's eligibility requirements typically follow the monthly installment schedule. When determining installment requirements, the CRA considers several important factors. These include the corporation's previous year's tax liability, the estimated tax for the current year, whether the corporation qualifies as a Canadian-controlled private corporation, and whether it satisfies all CRA eligibility requirements for quarterly installments. These factors help determine both whether installments are required and which payment schedule applies. It is important to remember that failing to make required installment payments can have financial consequences. If a corporation misses an installment or pays less than the required amount, the CRA may charge installment interest. In some situations, additional installment penalties may also apply, increasing the overall cost of non-compliance. The key takeaway is that installment requirements are based on the corporation's tax situation and CRA eligibility rules. Smaller qualifying CCPCs may benefit from quarterly installments, while many other corporations must make monthly payments. By understanding these requirements and making installment payments on time, tax preparers can help their clients stay compliant, improve cash flow management, and avoid unnecessary interest and penalties. There are several CRA-approved methods that corporations can use to calculate their required tax installments. These methods are designed to provide flexibility while ensuring that corporations make sufficient tax payments throughout the year. Choosing the most appropriate method depends on the corporation's circumstances and the accuracy of its tax estimates. One option is the no calculation option, where installments are generally based on the installment amounts calculated by the CRA, often using information from the corporation's previous tax return. This method is straightforward because it requires very little calculation by the corporation and is useful when business activity remains relatively stable from year to year. Another approach is the prior year option, which uses the corporation's previous year's actual tax liability as the basis for calculating the current year's installments. This method works well for businesses whose profits remain fairly consistent, since last year's tax often provides a reasonable estimate of the current year's tax obligation. The third method is the current year option. Under this approach, the corporation estimates its tax liability for the current year and calculates installments based on that estimate. This method can be beneficial when profits are expected to decrease, allowing the corporation to reduce its installment payments and improve cash flow. However, if the estimate is too low and the corporation underpays its installments, the CRA may charge installment interest on the shortfall. Once the installment amount has been calculated, the corporation makes payments throughout the year according to its required schedule. Depending on CRA eligibility, these payments may be made monthly or, for certain qualifying Canadian-controlled private corporations, quarterly. Each payment is credited toward the corporation's final tax liability. After the fiscal year ends, the corporation prepares and files its T2 corporate tax return. At that time, the actual corporate income tax is calculated and compared with the total installments already paid. If the installments are less than the actual tax owing, the corporation pays the remaining balance. If the installments exceed the final tax liability, the corporation may receive a refund or have the excess applied against future tax obligations. It is also important to understand the consequences of missing or underpaying installments. If required installments are paid late or the amounts are insufficient, the CRA may charge installment interest on the unpaid portion. In some cases, additional installment penalties may also apply, increasing the corporation's overall tax cost. Professional tax preparers can help clients avoid these problems by following a few best practices. Estimate taxes as accurately as possible. Monitor the corporation's financial performance throughout the year. Review installment amounts whenever profits change significantly. Maintain complete records of all CRA payments. And adjust future installments whenever necessary. Regular monitoring ensures that installment payments remain aligned with the corporation's actual tax situation. The key takeaway is that corporate tax installments are not fixed amounts. They should reflect the corporation's expected tax liability. By selecting the appropriate CRA-approved calculation method, making timely installment payments, and reviewing estimates throughout the year, tax preparers can help clients improve cash flow, minimize year-end surprises, and avoid unnecessary CRA interest and penalties.